Morning out there. This is the Enzo DiCasenzo podcast, and today we're going to be talking about plant assets and intangibles and some of the depreciation methods. And we're going to go without the camera today, if you guys don't mind. So we're just going to go straight to the PowerPoints because this is simply just a PowerPoint presentation. So we'll do that. Okay, so there we go. Plant assets, natural resources, intangibles. We're going to describe how the cost of the principal, how the cost principle applies to plant assets. And again, matching costs and expenses, that's something you're always going to be dealing with. So, I mean, we're looking at it in terms of this specific topic, but that's something that you'll always deal with if you're analyzing, situations and business deals and things of that nature. And we were on a call last night and we were doing that. Okay, so you're going to see a lot of that in that type of work. You're going to see a lot of that in that type of work. The concept of depreciation, periodic depreciation using a couple different methods, procedures for revising periodic depreciation, distinguishing between revenue and capital expenditures, and explain the entries for each. And again, everything goes back to the journal, the ledger, the financial statements. We're always going to be going back to that. Compute the periodic depletion of natural resources. The Saudis are going to care a lot about that with their natural gas deposits and petroleum deposits. The basic rules related to accounting for intangible assets and indicate how plant assets, natural resources, and intangible assets are reported. Now, we've already started we've already begun in class with the model, and actually just to throw this out at you guys, this is the template. So see what it says plant assets, and I basically reproduced this chapter in here, but in a live version of it. You can see you have journal entries here, and we already worked on like the first column here. These are just some entries and property and some of the costs associated with a real estate transaction. We're working on depreciation. Obviously, straight line is the classic beginning version of this, right? We care about straight line, then units of activity and declining balance. Okay, and again, we had some other entries here that we worked on. Okay, I don't know why some of these have answers here. These shouldn't have answers. Clean those up as we go along. But folks, no project happens without a piece of land. Nothing. And again, the people who don't say that are the people who don't know. So that's really, and we got a lot of them around. So, that's just sort of what happens with that. But yeah, cost of the assets, depreciation computations, certainly depletion, expenditures during the useful lives, plant asset disposals. And again, the gains and losses from assets, like instruments, it could be plant assets. Okay, those are important computations to make. And again, when you analyze your acquisitions, right, that's a big part of what I do down in Florida. When you analyze all of that, that's what people are going to ask you about. What a plant asset is, it's got physical substance, it's got a definite size and shape, it's used in operations of a business. You don't take it with you when you go to McDonald's. You don't leave with a chair, although some people may have. There was a picture of one of our guys out there in Brooklyn, walking away with a piece of Taco Bell or something, a piece of their plant property and equipment, aka the cash register drawer. So somehow he was running through the streets with that, and that got photographed by the video network system out in Queens or whatever that was. And again, obviously, Taco Bell's and the McDonald's and the Wendy's, they want to provide a service, a grill, a cash register, microwave, the counter that they put the sandwiches together on. All that stuff are your plant assets. And sometimes, if it's a school, they call it plant property and equipment, or fixed assets, or plant and equipment. I remember when I was working my way through the beginning of my college career, I had a work jacket and it said PPE on the chest. So, it's just like, like a little badge. like a policeman's badge, but it said plant, property, and equipment on there. So, and also depending on the type of company, and I just mentioned Wendy's. There's some firms that don't. Obviously, airlines are the top of the list here. Uh, you know, they have their aircraft and their other equipment. The field equipment, the trucks, and if you're moving the planes or whatever it might be, the baggage handlers and the ramps and the steps and the all that infrastructure. Go to an airport and just sort of look out the window. There's a lot of stuff going on around these aircraft, and think about aircraft carriers and heading out to the Middle East, that kind of a thing, and how you're floating something like that, right? You're floating something like that as opposed to having it sitting somewhere, right? So it's uh, that's quite a there it is. It's quite an operation to float the Eastern Mediterranean, that's for sure. Wendy's, I just mentioned it. They have a lot of the ovens and cooking equipment and the counters and the microwaves and the freezers and everything you need in an industrial kitchen. Walmart has a lot of stores. Nordstrom, same thing. Now Caterpillar's surprising because they're selling their inventory. They don't. I mean, of course they have inventory, but what's considered plant, property, equipment are their manufacturing facilities, and that's that's $1 out of $5 of assets. So okay, that's obviously that's a little surprising that it's that low. But again, they make specialized. They're not Caterpillar's, not Ford. How many bulldozers and dump trucks do those guys really? I mean, of course they make a lot, but it's not like vehicles. You're driving around. I mean, how many dump trucks do you see? How many or the digging equipment that might be on a trailer on the back of a dump truck or something? You don't see as much of that as you see vehicles. It's much more the ratio of just everyday sedans is much greater than you're not going to see a bunch of dump trucks bouncing around Route 3, a couple but not a lot. Microsoft, obviously anything technology, and also Microsoft, its computers and those things are relatively cheap compared to automobile manufacturing or aircraft or something like that. But still, they have to manufacture their products, and now it's all just on servers. And Microsoft may not even own the servers; they may subcontract that out to another firm. So this is plant assets as a percentage of total assets. So you want to look at the kind of a firm that, and none of these are good or bad. And obviously, this is, and if unfortunately, for better or worse, as you go down this list here, because you don't have the big depreciation costs. You're going to have these are all more profitable companies as you go down the list. Certainly Walmart's, but this is the most profitable, but with the smallest plant assets as a percentage of total assets. And airlines are always in trouble. It's a very cyclical business where when they're in trouble, when they're not in trouble. So I think there's a lot to be read into that's not a minor assessment of a potential investment. That's for sure. The cost principle requires the companies record plant assets at cost. The cost consists of all expenditures necessary to acquire an asset and make it ready for its intended use. Land, again, nothing happens without land. All necessary costs incurred in making land ready for its intended use increased, obviously you're going to increase the plus side of an asset debit with land in the land account. Costs typically include cash purchase price, closing costs such as title and attorney's fees. So there's always something attached. It's never just here's the money for the land and that you got to pay. You always need an attorney and title services. There could be commissions, but these are all things that are attached to, many transactions have this land or no land. But again, if you're going to build something, you need a piece of land to build it on. If there's liens or accrued property taxes, and unfortunately the purchaser has to assume those issues. Okay, so you'll be dealing with that. And I think we work this in class. This is manufacturing. Now, again, I'm discussing these on the PowerPoints. Okay, but the Excel is what you need. Okay, the Excel, and I've over the years I remember saying just cut the PowerPoints out of your courses and let's just go to the Excel. I've gotten those comments over the years, for better or worse. Again, we all have different different opinions on things like that. Yeah, I'm just looking for the best view for you guys. We'll just go to the reading view. But yeah, so we were here at this one, and there was real estate that was acquired for 100,000. The property contained an old warehouse, and the net cost of getting rid of that warehouse was 6,000. So in other words, you spent 75. We spoke about this in class. We spent 7,500 to knock down whatever structure was there, and then sold the salvage materials for 1,500. So you netted out 6,000, because 1,500 subtracted from 7,500 is 6,000. Additional expenditures, attorney fees, commissions, and I think we just, yeah, it's a determined amount you report as the cost of the land. Obviously, all of these stack up like that, and we worked that out in class. This is just these are just journal entries. That's just simply a journal entry. Land improvements include all expenditures necessary to make the improvements ready for their intended use: driveways, parking lots, fences, landscaping, limited useful lives. Depreciate the cost of land over the useful life. Buildings include all costs related directly to purchase or construction. Attorney's fees, title, insurance, all that. Those are purchased, remodeling and replacing, repairing roofs, floors. We had I don't want to say a neighbor, but it was a house on my block. I really couldn't call them neighbors because there was so much trouble. But and again, this is how fate always sort of takes care of you. I remember the beam, the main beam on their roof collapsed, and somebody came in, swooped in, probably spent 50,000 in repairs, bought the house for maybe as a distressed property, bought it for 150 and sold it for maybe 400,000. So made a healthy profit on that. I advised someone to do that, and they didn't do it. But what are you going to do? So that's just sort of what that looks like there. So and that's a very these are very common costs, very common maneuvers with acquiring an asset, sort of fixing the problems and selling it at a profit. We're just applying that to buildings. That's true a lot of the private equity deals and leveraged buyouts and things of that nature. Equipment includes all costs incurred for acquiring the equipment and preparing it for use. And again, reading the accounting rules, no matter what it is, you have to. That's your go-to. Is that your go-to is reading the accounting rules: cash purchase price, sales taxes, freight charges, insurance during transit paid by the purchaser, expenditures required in assembling, installing, and testing. I recently had I have 4 televisions in my house, and whatever. One of them was acting up or something. So we needed to replace. I think it was just the remote control needed to be replaced. And I called or whatever the Verizon guys and talked to the FiOS people and sorted through all the phone numbers I have for all these companies. And I think what happened was they said, look at your equipment is so old, it's so old. So they sort of talked me into new equipment, and they said, would you like us to install it for you? And I said, well, I'll pick it up. And I said, direct me to one of your stores. And no, actually what they did was they mailed it to me. It came mailed in a box. And what I had to do is I had to return the old equipment. But what I'm trying to say is I would have incurred an extra cost having one of their technicians come by and put everything together for me. But I did it myself. It took a couple hours, and it was good though. Vacuumed around all the TVs, which is always difficult to do. Keeping those areas, dust free is always a big challenge. But you can save a little bit if you have a little bit of electrical engineering skill, which has never been. So anyhow, but these are all the costs incurred with purchasing equipment, tax, freight charges, insurance if it needs it. Okay. This one we bought a truck or something, and again, there's no Ford F-150 you can buy for $22,000. Okay, but so this was written maybe 30 years ago. These problems, these are old problems. Okay, so that's just sort of what that is. And the vehicle itself was 20,000. Sales tax was an extra 1,000 and a little bit, and then some. And obviously, the guy who works on my house, I reference him all the time. Honduran guy, right? He's got a black truck with yellow lettering, and it pops. It really pops out. It's a good color scheme. And so the total cost is 23,000. Now it's easily double, especially this 22,000 here. This is triple, maybe, or more for a truck. And they'll prepare the journal. So from making your expenses, you're going to do this is the journal entry. So what you're doing here is you're converting very liquid cash into a far less liquid asset known as plant assets or heavy assets, right? Plant assets or heavy assets. We use that word sometimes around the office. So, okay, so you've converted 25,500 into equipment and then some other expenses associated with licensing expenses and prepaid insurance. Now, if you look at this, that 23,000 is includes the lettering and transportation, right, from the previous slide, right? Sales tax. Here now you have these periodic costs. You know, you have the insurance that's going to have to be paid every month or whatever it is, licensing expense every couple years or something like that. Okay. I didn't run to this this Wall Street Journal, most likely Wall Street Journal article here, but this says something to the effect of leasing is big in business for his companies, and business investment in equipment is yeah. So obviously that came from the GDP table, business investment in equipment. The breakdown from the Department of Commerce site broke it down at the time the book was written to about 700 billion. It's probably $1 trillion now, just in business investment. Leasing accounted for about 31% of all business investment in the world. Okay, so yeah, so all business investment was 700 billion, now probably $1 trillion, and then about a third of it is business investment. It says who does the most leasing? Well, banks. This is the financing. Major banks do it, or the major lessors. In other words, that they provide the leasing. And actually, let's just check that, if you guys don't mind. Yeah. So obviously the banks they lease property or assets is what they do, and the banks are the big ones that do it. So JP Morgan is a big one. So they must own the property, and that's a big part of their balance sheet is the property that they own. All right. And Boeing established separate leasing companies. Dell, I use Dell Financial Services whenever I buy anything, even though I could afford it, but it's zero interest, right? So I say, hey, give me a year to pay the computer off, and I'm happy to do it. Planes are 40% of the U.S. fleet of commercial airlines are leased. Hotels that are owned by someone else, and they just operate them, kind of a thing, and work out the numbers. Okay. And also, again, I always stress in my classes, whatever class it is, income statements and balance sheets, and some classes more than others, but certainly to understand how that process all works. Depreciation, allocating to expenses the cost of plant assets over useful life in a rational and systematic manner. Process quote, not asset valuation. So yeah, so we're cost allocating, not asset valuing, and asset valuation is a big part of what I do down in Florida. But cost allocation and the accounting layers of the world, they care about the cost allocation a lot. Land improvements, buildings, equipment. Yeah, so when you depreciate, you're depreciating buildings, equipment. Land doesn't depreciate because it's fixed. It's unless the earth explodes one day. Okay, it'll be fixed. We're generating revenue production of an asset, and that can if it's a truck or something that can decline. But with land, you can always build a house or knock the old house down, put a new house up, and convert some other revenue producing ability of that asset. We had a Westinghouse near where I live in the North Ward of Newark, and for years it was the structure was there, and then the structure was knocked down. Then it was empty for a long time, and now there's about 8 sets of condominiums or rentals there, and there's 8 of them, so it must be thousands. It's got to be thousands of apartments or of living spaces there. So it's a lot. So in other words, the revenue producing ability, it was manufacturing, then zero, and now It's rentals, which is, I guess, the story of the Northeast. Factors in computing depreciation. There's a cost. There's initial cost. You run down the and notice the truck, how it's a little more beat up as you go down the hill. See here, it's dented and broken windows. It's a nice graphic, and this one's sort of a medium beat up a little bit, and this one's brand new. So they have now there's scratches on it. So costs are all expenditures necessary to acquire the asset and make it ready for intended use. Useful life, estimate of the expected life based on need for repair, service life, and vulnerability to obsolescence. And salvage value is the estimate of the asset's value at the end of its useful life. Okay, and like I said, so we sold some scrap, right? When that the initial example where the structure was knocked down, we sold the copper piping and the copper wires and things of that nature. There's a couple methods that we're going to look at. Most of them are straight line. If you look at and really for all the work that we're going to spend in 70 slides or whatever it is that we're going to spend talking about this today, when you look at the annual report, this is a few lines, and everything is like that on account. There's a lot of work behind it, but when it's reported very in a very benign way. So declining back, and it's funny, I took 4 courses when I went to NJT in my junior and senior years, and I think it taught me everything I needed to know about corporate finance, everything I needed to know about depreciation, everything I needed to know about capital management, and it was highly mathematical. You don't even see those kinds of courses anymore, which is unfortunate. All the corporate finance, even the good corporate finance, it's very watered down, and I'm not saying that in a bad way, but they're very watered down. The treatment that I got when I went to NJT was very rigorous and very mathematical, and it's just not really done like that. So I'm saying it's good to know. It's good to have a good understanding about it, but it's done at a very sort of user-friendly manner. And management selects the method it believes best measures the asset's contribution to revenue over its useful life. Actually, we may have worked on this one also. This was the first depreciation example. So actually, we got pretty deep into these chapters in class. There's an initial cost. There's a salvage value. Now, you're not depreciating the $13,000. You're depreciating the net of cost versus salvage value. So you got to subtract the 1,000 from the 13,000. Divide by 5 years. You can use the Milds version of this, and we'll show you how to do that. But for the straight line, and again, this is all worked out in Excel, so don't worry if I just sort of go through this. I'm just explaining what the topics are. The actual computations, you need a spreadsheet. I mean, there's just you can't do this without a spreadsheet. So you have a cost minus the salvage value. What is the depreciable cost? Divide by 5 years, and then you have the depreciation expense. So cost less salvage value is what we're looking at here. Okay. And that you make a table, and this is made for Excel, something like this. You accumulate that, you add up, you accumulate the accumulated depreciation, or all these 2400s added up. If you get to the last one here, obviously you can see that's your 12,000, right? This 12,000, right, and that those are the same. That's what you're depreciating, and you depreciate a fifth at a time. So, and this is a good exercise for book value. How you book your asset, how you book the asset's value, which is right there. So you recognize the expenses as a debit, the accumulated depreciation is a credit. It's a contra asset. So that accumulated depreciation would be plus, and you balance that. Let's see. This is from the the assets getting written down. Is what that is, right? I know this is that, I forget if that's under liability or not, but this is under expenses. So this is a plus with a negative in front of it, and this is a negative. This is under assets. This is under assets. This 24, because the negatives have to balance, right? So again, see, even if you're unsure of something, right, you can say, well, I'm sure about this. This is a plus with the negative, so that's got to be negative. This is under assets, right, and this is going to be on the negative side, and it's going to add up. It's going to accumulate on the credit side of the asset is what it's going to do. So book value, this dwindles. The accumulated, it just keeps getting subtracted out. And if you look at this down to your 1,000, that's the 13 minus 1,000 is 12,000, or 13,000 minus 12,000 is 1,000. So that's how you get your book value. You just keep subtracting out all the depreciations, all your write downs is what you're. See, the first one is 10,000 after the first year. It's 10,600, which is 12,000 minus 2,400. Okay, but again, the what do you call it is gonna the Excel sheet's gonna make it look better. This is straight line method. This this is a partial year example. So for 12, if the purchase was done in April, I didn't work this problem out with the Excel. But I probably should have. But what you can do is, so it's the first year can be a partial, and then you're still going to write down the other 5 years, right? When you say 5 years, so it's a partial the first year, and then 5 more years, including. So this should be ending April 1st, 2017. Is what this should. So you have 1, 2, 3, 4. Yeah, you have 5 full years, and this is going to be the last year. This will be right. The first 3 months of that year. So this adds up to 5 years. This is another way to look at it. It just sort of breaks it up, and I probably should create the Excel for that. And this is just the first entry. That's just the first entry. There's the 2012 entry there. In terms of a partial, you can see it's less by a couple hundred. It's less by about 600. Which is a quarter of, because a quarter of 2,400 is 600 minus 2,400 is 1,800. Okay. But again, in Excel, we'll worry about that. Units of activity, you take the 100,000 miles. The depreciable cost per unit is 12 cents. So how do you do that? You take 12,000 divided by 100,000 miles is 12 cents. And then the miles for the year. And then you determine your appreciable expense by the rate times how many miles you drove the truck, the Amazon truck. So UPS, they care about that a lot. Depreciable cost is the cost less salvage value. Expense vary based on units of activity. Companies estimate total units of activity to calculate depreciation per unit cost. And again, we're just going to, I think, again, in class, I think one of the classes we worked on this already. So what you'll do is you'll take the rate times the hours or the miles used, the hours used. It says hours, but I think it's miles. Yeah, it's miles, 15,000. This the book said hours, so obviously, so little bit of an error there with the book, but okay, it's miles used. You have the rate, you determine the expense, and then you just add up the accumulated depreciation, then you subtract out from book to get to 1,000. So the first year it's going to be 13 minus that 1,800, right? Is 11,200, and you're gonna get all the way down to the salvage. And again, different people I think worked on these. That's 11,200. Actually, no. This is the book is 13. Yeah, so you keep it's from book, right? Because it's not. This is not 2,400 minus 12 would be 96, not 10,600. So it's from 13,000. Then you have the journal entry for the first year. And the accumulated depreciation balances the depreciation expense. This is a third method where you take twice the rate of the straight line version times the beginning book value times that 40%. It gives you an annual depreciation of 5,200. This is called double declining balance, and I think we do 40% every time of book of whatever. That's why. So for the first year, the expense is 5,200, and it balances with the accumulated in the annual expenses balance. This one, for whatever reason, we didn't get to work this out in class, so we'll figure out why we're adjusting slightly with that. We'll see what that looks like when we sit down to do it. Okay, so it's twice the rate, and it's going to be 40% of every book value, of every beginning book value, every single time, is what you're going to do with this. But again, we'll work this out in class. And here's again, they're doing the partial year versions of this also, which is a smart. That's a smart. Then I guess they're using a plug. All right, but we'll work all that out as we race through all of this. But okay, so we're just introducing the methodology. You need to generate this in Excel. That's where it's going to make the most sense. And then now you're comparing the three methods, which, and this is a typical common thing to do and to have to think about. And again, if you look at this, you're depreciating that 12,000 every time. That's what you're depreciating, but that's the way you get there. Obviously, you get a very uniform version here, and then these are a little more. This is erratic, how you get this one, and this one just declines quickly, almost exponentially. That one, and yeah, that's the blue one, right? With a e to the x negative, constant, and then a bit on the erratic side. But most of them are straight line. But they also recognize the client services of the asset in a rational, systematic manner. Depreciation and taxes. The IRS doesn't require taxpayers to use the same depreciation method on tax returns that it uses. So yeah, so also the people who study companies and read annual reports, you'll learn this. Excuse me. You'll learn this when you get into taxes, what the tax regulations are in terms of reporting and what the SEC requires in terms of reporting of financial information can be different. Those are two different federal agencies, and they may not have the same requirements for a variety of reasons that were most likely lobbied at these firms. When they were when you have lobbyists who spend a lot to lobby to convince lawmakers to make the rules in a certain way that's beneficial to their employers who employ the lobbyists. There's modified accelerated cost recovery. This is not acceptable under GAAP. So this might be used in Europe or something. So, but again, the IRS, the SEC, right? They have their own requirements. You could revise periodic depreciation, and I'll tell you, with those partial year versions, we might have that somewhere in the problem. So we'll look to see if we may have worked on that, because I outlined this long ago, this chapter. So it's been a couple years since I've looked at it. So revising, so you don't consider an error when you do a periodic depreciation revision. And it's not handled. You don't go back in time. You don't consider an error and you don't go back in time. So actually here we're doing some sort of corrections here. Equipment was purchased for $500,000. It had a 10-year useful life and a salvage of $10,000. So on a straight line basis, it's $500,000 divided by 10 years. So it's $50,000 a year. But in year 8, a change was made, and the salvage value was altered a bit. So we had to make that adjustment to our journal entries. So you want to calculate the depreciation expense and the journal entries so there's no entry required for that. You don't correct previous versions. And this other thing, after 7 years, where you take your book value and then you generate a new version of a new set of depreciation expenses based on the latest book value is basically what you did. So you write off for 10 years in the appropriate way. You figure out what your book value is, and then you go from there. So if you accumulated as 360, your new net book value is 160. I'm sorry, 510 minus 350 is 160. And then you compute a new salvage and a new annual depreciation. And then you have your journal entries for future years based on those numbers. But again, we'll illustrate this with Excel examples, and it'll be very clear when we do that. Expenditures during useful life. Maintaining operating efficiency and productive life of the unit. Debit, right, a repair maintenance expenses debited. And these are referred to as revenue expenditures. That's ordinary repairs. Additions and improvements. These are capital expenditures. The cost incurred to increase operating efficiency, productive capacity. So again, I interned at IBM. I don't know why I was thinking about it the other day, but long ago. It was your lifetime and much more than most of your lifetimes. And it was at a manufacturing facility, and it was just level. a kid from like me, grew up in Newark and New York City and Queens and all these things, used to big tall buildings, and what a shock it was driving up to Dutchess County, and IBM had no second floor. I sat there, I asked, I said, "Where's the second floor?" So there was no second floor up in Poughkeepsie, up in Dutchess County, and yeah, so uh, you know, if you and what happened was if they added on additions as the business grew, and you just added it on sort of horizontally. You just sort of put a new build, a new building, a new building, a new building as you went along. There was a brick and mortar building, and then there were a bunch of buildings that were considered temporary that weren't really temporary any longer. So, but so capital expenditures expanding your production capacity, new cars, different cars. Maintenance expenses are not capital expenditures; they're considered revenue expenses. So that's the differences between them. And this is just some sort of we're looking back at all the frauds that happened over the years. WorldCom was a big one. They increased in a series of largely debt-financed acquisitions of other companies, and the acquisitions made the company grow quickly, which made the stock price increase dramatically. But the acquired companies all had different accounting systems, and the financial records were very inconsistent. And when WorldCom performance started to flatten out, the CEO coerced the accounts to engage in fraudulent activities to make the income look better than it really was and prop up the stock price. The frauds involved treating $7 billion of line costs as capital expenditures. The line costs were rental fees paid to other phone companies to use the phone lines, had always been properly expensed in previous years, capitalizing delayed expense recognition to future periods, and thus boosted current. So in other words, you didn't recognize it as an operating expense. You recognized it as a capital expenditure, and then you got to depreciate it is really what happened here. Documentation, independent internal. So that was the cash chapter. So I don't know if you read the cash, but the cash chapter had a lot of these sort of let's forensically look at when things go wrong, why things went wrong kind of questions. So and also the magnitude. So it was just total take, the magnitude of sort of the underhanded thing that happened here. The accounting system were all non-integrated from a variety of different corporations had different accounting systems, and management took advantage of this to conceal, underhanded activities. You need internal verification. The fraud should have been detected by comparison of physical assets with a list of physical assets shown in the records, but obviously people were paid to look the other way and did. So, disposing of assets, retirement, sale, or exchange. Sale equipment is sold to another party. Retirement is scrapped or discarded, or exchanging equipment is traded for new equipment. All of these happen by debiting accumulated depreciation and crediting the asset account. That's how you eliminate it. You're right off the depreciation. You're right off the asset. Retirement of planned assets. No cash is received. You debit accumulate for the depreciation for the full depreciation taken. So that's one of the rare times, not the rare time, but that's when you debit accumulate depreciation when you dispose of the asset, and then you credit the asset account for the original cost. So you're writing off everything. It looks like that. You don't. This is your write-off. You don't have the printers, and then you corrected you closed out your depreciation. If this is what happens if it's still well, I mean, you just keep going, I suppose, right? If it's still useful, I don't know why you throw you eject something that works, but hey, this is the Catholic Church. We'll say it like that, right? We could say it that way. Sunset discards delivery equipment at a cost of 18, and the cumulative is 14. So there's 4,000 left, and yeah, so you wrote it off, and then unfortunately you got to balance this with a loss, right? Because if you only depreciated 14,000, then you sold it, you're losing, because that's all you can depreciate. You're going to lose another 4. You got to recognize it as that. Other expenses on the income statement, and again, reading your income statements is extraordinarily important. Sale of planned assets. Compare the book value of the asset with the proceeds received from the sale. So if the proceeds exceed the book value, the gain on the disposal occurs. And if the proceeds are less than book, there's a loss. So okay, so if the proceeds exceed the book value, it's a gain. If the proceeds are less than the book value, it's a loss. Again, that works for plan assets. That works for a lot of things. So that's a good example. This one is office furniture. Excuse me, office furniture sold for 16,000 cash. The furniture cost 60,000 originally. The accumulated depreciation was 41,000, and the depreciation for the first couple months of 2012 was 8,000. Prepare the journal entry to record the depreciation up to the date of sale. Well, yeah, that's an easy one. If that's just a partial, that's the first 6 months of the year depreciation measure is what that is. Okay, that's not too big of a deal. Um, the proceeds were 16,000. Book was 11 because you wrote off 40 here. It says you wrote off yeah, with the 8,000 you wrote off 49,000. 41 plus 8,000 49. The book is 11 and you sold it for 16, so your gain is 5. There's your gain. And under owner's capital or equity, that credit is a plus. So that and your other comprehensive income, that's how you add to that. You're writing off the equipment, you record some cash, you wrote off your depreciation, so you netted 11, and then the 16 and 11 nets at 5,000, which is your gain. You sold for 9,000 instead of 16, and this is a loss version. Obviously, you're 2,000 below your book with this. So you brought in 9 in cash. Your accumulated was 49. Your original equipment was 60, and unfortunately, balancing that out is the 2. Okay, so that's also something that you'll see. Natural resources, timber, underground deposits of gas and minerals and oil, petroleum. You physically extract them in operations and are replaceable only by an active nature. Okay. I always the Wall Street Journal always has great pictures. Uh, yeah, I was looking for someone who wrestling with a wellhead. Yeah, these are all very clean. These are all from the annual reports. It doesn't show the guy. Yeah, this one a little bit where they're it's something like this, and they're trying to connect a line to the pipe in the ground. See, this is how you get gas wells and oil wells and those kinds of things. That's a gas well, oil well. Okay, try to connect with all the pressure that's involved in this. Let's do wellhead. Trying to connect it to this. Yeah, they're not showing. Yeah, see, this was the dirtier the better. But and it was a great. It was in the Wall Street Journal a number of years ago. It was a great picture. These guys are really wrestling with it terribly, and they were splattered and all that stuff. I didn't see them wearing suits like this. I didn't see any of this stuff. But yeah, something like this. But it was intense. It was a very intense. Well, yeah, here they go. Pick some of the pictures. These guys from long ago. I'm not going to expand that one, but okay, yes, these are coal miners, petroleum. Okay, but it was really good. See, it's almost like this, almost, but it was the oil was just going everywhere. Anyway, we'll search that out we'll search that out for another day. Yeah, this is furniture. So we stop there. This is furniture, 60,000. Depreciation was 41 on 8, and it was sold for 11. So yeah, no, this is yeah, this is that 5,000 gain. Okay, we looked at that. Yeah, this is office furniture now. Is the next one here? Uh, it's so okay. This sells it for 90. This is the loss. We looked at that one already. Physically extract operations replaceable by inactive nature. Okay. Courts need to acquire the resources and prepare for intended use. Folks, all this material, this is all in the chapter. Just read the chapter 10, and it's all in there in the accounting book. Allocation of the cost to expenses in a rational and systematic manner over the resources used for life. Depreciation is to natural resources as depreciation is to planned expenses. We can use units of activity. Depletion generally is a function of the units extracted. So coal company, they invest which I'm sure is low, and 5 million in mine, and they expected to have 10 million tons of coal and no salvage value. They're expecting to extract about 10% of coal in the first year, and we're looking to compute the depletion expense. So it would be 5 million divided by 10 million tons of coal. Excuse me, 50 cents depletion cost per ton, and we pulled out 800,000. So actually, yeah. So this would be the expense should be 400,000 in the depletion expense, and that works with the same thing. Accumulated depletion, it works the same way. And you can see, so when you report it, that 400,000, you can see it's very innocently reported here, but there's some work involved in getting there. These are extracted resources not been sold or reported as inventory in the current assets section. These are intangibles. Rights. I took a whole course in intellectual property at Queens College a number of summers ago. Rights, privileges, and competitive advantage that results from ownership of long-lived assets that don't possess physical substance. Patents, copyrights, goodwill, trademarks, franchise or license. Limited life intangibles, amortized to expense, credit asset account. Indefinite life intangibles, no foreseeable limit on time. The asset is expected to provide cash flows, no amortization. Patents are exclusive rights to manufacture, sell, or control an invention for 20 years. Music is an invention. A book is an invention. Harry Potter is an invention. Lord of the Rings, those are all inventions. Capitalizing the cost of purchasing a patent and amortize over 20. So yeah, so if you capitalize the cost, that's using the depreciation version of things. Saying, okay, we're gonna put it on a balance sheet and then write it off every year, as opposed to just expensing it every year as one big hit. So you're spreading it out over a number of years. So this is used in a lot of things in these financially engineered situations. Expense any R&D costs in developing a patent. Legal fees incurred successfully defending a patent or capitalized to a patent account. All right, never forget the lawyers. That's all I got to tell you. I never forget those people. National Labs purchased a patent for 60,000. National estimates the useful life of the patent to be 8 years. Prepare the journal entry to record the amortization for a 6-month period. So it's 60,000 divided by 8 years, which is 7,500 a year. And then if you just look at a 6-month period, it's a fraction of that 7,500. Copyrights give the owner exclusive rights to reproduce and sell an artistic or published work, granted for the life of the creator plus 70 years. trademarks, phrase, jingle, symbol that identifies an enterprise or product. I think what was the guy? This is before your time. He was a ring announcer for, I don't know if it was wrestling or boxing. It could have been boxing. He would say something like, "Let's get ready to rumble," and he copyrighted that. And someone tried to make a song out of it or try to use it, and he sued them and won because he said, "That's my trademark. I made that. That's recognizable to whoever that was." Where's the beef for Wendy's long ago, right? They had the mom of the owner of Dave, right? That kind of a thing. It was his mother who his mother was in the commercial, and then she passed away. He passed away. Then it was the daughter. The little picture on the ketchup is the daughter, like the little girl with the hair, the pigtail hair, that kind of a thing. Coca-Cola, certainly you can't just call yourself Coca-Cola or whatever. If you guys, my mother likes the movie. It's called Coming to America with Eddie Murphy. Again, before your time, most of the kids in these classes. That movie was out in the 80s, like 88, when Eddie Murphy was really huge actor at the time. And John Amos, who was in Good Times, which is even further back in television lore, was a dad on Good Times. It was in the Chicago high rises in the 70s. He played a fast food fast food restaurant owner, and he called it McDowell's instead of McDonald's. And he was always worried that McDonald's was going to come by and say that his business was too close to what their their trademark or their trade name was. And he says McDonald's has golden arches. He says, I have golden arcs, or something like that. It was a slip, but it looked like a McDonald's with the yellow M and all that stuff. But he was always worried that somebody from McDonald's was going to come in and say, "This is McDonald's, and you're not paying us, and you owe us a franchise fee," and that's what he was always worried about. So anyway, legal protection for an indefinite number of years, a 20-year renewal. So yeah, folks, this whole thing about the patents and the trade names, it's not forever. You have to renew it and go to court and apply. And so that shocked me. That you ever notice how, like, remember Bill? Again, you guys probably don't know who this is. Billy Joel, who's a big entertainer, a New York. He's like a Bruce Springsteen kind of a guy. He's a single. He has a band, but he's like a single entertainer, singer, songwriter, piano player. He has not made new material in 20, 30 years or something like that, probably 30 years. And the reason it is he stopped making new material was something happened where the rights to his music, the record company owned it and they didn't pay him and he was bankrupt and this and that. So I think he just got very sour on the music. And he was in the 70s, his music from the 70s was tremendous. I mean, if you look back at his I can't remember the names, like Glass Houses and his records, but again, back when music was maybe a little bit of a different business than it is today. But his poetic view of life in the world and relationships and growing up as a 20-year-old in New York and Italian restaurants and it was one after the next of just really good songs. If you look back at his 1970s catalog, I have all of his records from the 70s marked on Amazon. I haven't picked them up yet, but I want to buy just what he put out in the 70s. And he put out like an album of music like every year. But something happened where, those artists, the owners of those companies acted unscrupulously and said, "Hey, this is ours, not yours," and whatever. We paid you to produce this, and you produced it, and it, the business part of it reared its ugly head, and I think stopped him from creating, for 30 years. Springsteen kept going, but I think Springsteen fought it a little bit better. Prince fought it a little bit better and won. So, you have to fight things a bit, and that's how you sort of get some progress. But we don't really live in a time of dissenting opinions any longer. The country that we have now, you can't. If you dissent, you're in a lot of trouble, and that's true, and especially in the cities. Franchisees and licensed Subway, Shell, they have a limited life and are amortized to expense over the useful life of the franchise. Franchise with an indefinite life should be carried at cost, not amortized. So again, writing it off once or capitalizing or writing it off over a number of years, those are all the accounting decisions that you have to make. Goodwill, management, location, customer relations, skilled employees, quality products. This is only recorded when the business is purchased, but this could be a very big number. This could be a very big number. Goodwill is considered the excess of purchase price over the fair market value of an identifiable net asset when it's acquired. FMV is fair market value. And this is not a small number a lot of the times. Internally created goodwill should not be capitalized and not amortized. And there's all sorts of rules of dealing with that. Research and development costs, expenditures that lead to patents, copyrights, new processes, new products. These are expense. Research and development costs are expense when they occur. These are some questions here. It says identify the term most directly associated with each statement. So obviously that the first one's depletion, allocation of the cost of natural resources. Rights and that's obviously intangible assets. Exclusive rights granted by the federal government. That's a copyright. Sell artistic or published work. An intangible asset is a competitive advantage from a long-lived asset and doesn't possess physical substance. A right to sell is franchise or services or use of certain trademarks or trade names. Costs incurred by a company, research and development costs. These are just a couple questions here, so you keep all those terms in mind. SoftBank was a big internet company and boosted a profit margin from 3 to about 11%. And they were accused of accounting tricks. They wrote down the value of the mobile unit asset by half. This would normally result in a huge loss, but rather than take a loss, the company wrote up goodwill by the same amount. And how did it move? How did this move increase earnings? The assets were being depreciated over 10 years, but the company was amortized over 20 years. Now, if you can do it, do it. But if it's illegal, obviously don't do it. If it's not, you're out of the regulations, you certainly can't do it. Amortization of goodwill was allowed under the accounting standards. It was followed at the time, but when the new treatment did not break any rules, the company was criticized for investors for not providing sufficient justification for a detailed explanation. Wall Street Journal has this. So some of their accounting decisions, and again, so how you recognize expenses is really this thing, WorldCom. That's all the same conversation. Okay, so you can look this up from whatever it is, 15 years ago or something like that. You certainly can look that up. Presenting all this work that you did. Here's property, plant, and equipment. Here's you're subtracting out accumulated depreciation, buildings and equipment at cost. These are the lands minus already less depreciation was whatever this was 95 million. You're netting this out to 978. You're adding these up and then subtracting out the patent, or not subtracting, you're adding up the patents to that whatever is that billion and property, plant, and equipment. So yeah, this is a little bit of a complicated one. I don't know what Owens is, Illinois, but I don't know if they're these special bottles, or I've seen these bottles where it puts pressure on the top. You can see this. My father used to make wine and had bottles like that. Net sales by average total assets. That's asset turnover ratio. You need little debt ratios like that. People love ratios, but know your numbers. If you know your sales and you know your assets, the turnover, you can almost just do this in your head. That kind of a thing. You can see it's about half, right? You can always see that. So for each dollar invested in assets produces 57 cents in sales. If it's efficient, the dollar of assets will create a high amount of sales. Okay. And that's it. We're to the appendix here. Companies record or gain or loss. The appendix is 62. I don't know if this works very well. Back to slideshow. See the slide. Zoom the slide. Mark this. Does this work? Oh wow, laser pointer. Oh wow, look at that. I should probably use some of this stuff. All right. Look at that. That's nice. Wow. So I don't know. Maybe I can use this a little bit too. This is exchange of assets, of plant assets. Recorded gain or loss on the exchange of plant assets. A lot of the exchange of commercial substance, and commercial substance is if the future cash flows change as a result of the exchange. And we have this here. We had old trucks at 64,000, less 22,000 cumulative depreciation, plus some cash that we paid out for a new semi truck. And the old truck had fair market value of 26,000. Okay, so you have a cost. You took out the depreciation. You have the book value. You have the market. Okay, so you exchange something for, there was book value at 42, but you exchange it for something that was 26, and then more cash was 43. So the cost of the new truck was the fair market value of the old truck plus what you threw in it in terms of cash. And again, we'll work these out. We'll work these out more in the Excel. Yeah, you have various sides of this transaction: new equipment, accumulated depreciation, loss on the disposal. We'll work all of this out in Excel, but it's just giving you the and then you have the gain, right? You have a delivery trades its old delivery equipment for minus accumulated for new delivery equipment. The old had a fair market of 19, and then another 3,000 in cash. That was the 22, and the gain was 7 from that. Okay, because if you're looking, the fair market was 19, but your book was 12, but you valued it at 19, so that's how you have the gain. Okay. And again, this is just the journal entry here for that. But again, we have to go through this, in Excel. We got to go through this in Excel. How to get the gains and losses. And now all of this stuff, these, not that they're not important, and actually these are actually pretty important, but how GAAP and international IFR is, what is that? This is the international financial reporting standards is what this is. Okay. And there's a couple of them here. And I generally don't go over these. You guys can read them if you want. Okay. So we had the appendix. We looked at the appendix with a little more complicated problems. But like I said, this will all be worked out in Excel, and we'll look at it then. Folks, thank you very much. Okay. And I apologize for not having the picture up today. And so where is it? This thing is here. Stop sharing. Okay.